Many challenges, including the power crunch, COVID, not to mention China regulation, Fed policy, Evergrande. They seem to be a lot to overcome. So what will drive markets higher?
So I think this boils down to the basic question about what's your view on the cycle, right? If you think that we are into a late cycle situation where we're headed into a recession, then of course there's more downside to markets. But that's not what we think. We think that growth is basically slowing down from the very strong pace that we saw in the first half of this year, but it's kind of going to stabilize into a mid-cycle environment. This is typically what we see in all the historical cycles that we've seen, and this mid-cycle environment tends to last several quarters at least. And if you look at all the things that's still pending, reopenings yet to happen, a lot of this capex is yet to happen, order books are very long at various companies, inventories are extremely depleted. So you put all these things together, and the view on the cycle remains that it will survive, which means that we are now at a point of judging when the inflection in growth happens. And if you look at the PMIs that came out last week, there is some tentative signs that growth is already bottoming. And then in terms of the market risk, yes, you have to kind of price those in. So we turned constructive in August, and we have seen a downturn again in September. So that's because some of these events. But you will eventually get past these. And like you saw with the FOMC, once you get past these event risks, the market will recover.
Treasury yields have come down a little bit from the surge that we saw in recent days, but still that has led to that continued rotation into value. As this GTV chart on the Bloomberg shows, we have seen that in Asia very much. Is that the narrative that will continue into the fourth quarter?
Absolutely. So not only is value seasonally very good aligned for 4Q in January, that's when typically it tends to do the best, but also if you look at various other factors, commodity price upside happening right now. You have bond yields moving higher, especially real yields, which we think will continue to move higher. Then you have reopening happening in various parts of the world. And in Asia, if you look at the stocks where they are, we're still yet to price a significant amount of this reopening. And finally, one technical thing that we look at very closely is the amount of crowding in various factors. And while value was extremely crowded in mid-May when it started to underperform, right now the situation is exactly the opposite, where momentum is extremely crowded, and we think there could be more downside to various momentum spaces here.
I want to take a look at the energy crisis and how much that really plays into sentiment and growth prospects, right? This chart really showing how much of a jump we've seen in natural gas prices. We have seen also that catch-up play when it comes to crude as well, right? $190 a barrel equivalent when it comes to nat gas, and still going ever higher. Is this something that's adequately priced in by markets? Because I don't think it's really something that people had been expecting would happen going into the end of the year.
So there's two parts to this, right? Like the first thing is that energy prices are rallying, so energy stocks will do well. So this is part of our value argument that, in fact, I would say that energy is probably the sector that we are currently most bullish on. Where all these factors align. You look at positioning where it is, you look at momentum in terms of growth, and you look at momentum in prices and commodity prices. It all kind of aligns well for energy to do well as a sector. The second thing, like you mentioned, the conversion of gas to or oil to gas for heating and power generation purposes is going to drive the next leg higher in oil. We do think that there could be an overshoot to what we expect our baseline forecast of $84 a barrel for Brent crude in Q4. But if you get an overshoot to that, you could easily hit $100 per barrel, and that's a very realistic scenario. Then the second thing you think about is what impact does that have on the economy? And here I would say that a sudden spike in oil prices probably doesn't mean that much, but if oil prices were to sustain at 100, 150, in that range, 100 to 120 or even higher in terms of oil prices, and remain there for 6 months or 9 months, that will start to have a negative impact on the economy. I don't think that that's what we are heading into. So once we see that, or if and when we see that, we will start planning for that.
The other risk, of course, we continue to watch is Evergrande and what happens with that $260 million bond that's due today. We're no longer talking about a systemic risk, right? We're talking about ring fencing by Beijing, the sort of selective approach to giving some support. I am curious what this teaches the investment community about how China views and will deal with foreign investor debts that are owed, though.
No, I think there's two. You have to look at it in two ways. First is Evergrande as a company, and I really have no comments there in terms of how that situation will be resolved. But really, the bigger question is how the spillover or the financial contagion aspect is being contained. And there we do seem to be getting signs that the government is planning to contain this. They are aware of this, the potential for this to become systemic through various channels in the financial markets. And there are attempts to, kind of mitigate that effect. And especially in the past week or so, we've started to see those efforts being stepped up, including liquidity injection by the PBOC. So we do think that this, the contagion fears from Evergrande are probably a bit overblown. How this affects foreign investors, foreign bondholders, again, specific to the company, we will see how that resolves. But in the rest of the market, we continue to see investors being reasonably okay with bonds. If you look at the largest amount of foreign investment in Chinese fixed income markets, it's mostly in government bonds. So that part, I don't think has really been affected.